Seasonality is an incredibly powerful tailwind for markets, and I don't see any reason why rising COVID cases out of China, for instance, should derail that.
Well, because then there's some serious questions about the global economy.
Sure, and I think that's more of a multi-month or multi-quarter story. I'm always fond of reminding people that even the depths of 2008, December was an up month. And so, just to underscore the power of seasonality.
So you're still kind of bearish long term, it sounds
Yeah,
like.
I mean, listen, your lead-in mentioned that next week we get the employment report and we have the ISM report.
And Powell speaks Wednesday and takes questions.
And Powell speaks Wednesday and takes questions. I think investors in general, institutional, where we live or retail, have to wrestle with two competing narratives right now. And the first is the Fed going to be able to engineer something resembling a soft landing, i.e., inflation rates have been coming down, the economy has been slowing, they're going to slow the pace of rate hikes, and they can land that plane, so to speak? Or, if you're in the camp I'm in, you just don't believe that 500 basis points of rate hikes in a 12-month time frame or so results in only weakness in the housing market. And the U.S. economy needs to be thought of as something akin to a very large cruise ship that turns very slowly, and we're in the process of making those turns towards weakness.
You think it's going to be an uglier economic story next year?
Yeah, well, listen, ugly is subjective. I think it's hard for me to imagine that you're not going to have a higher level of jobless claims, a greater number of job potentially losses, but certainly less higher level of jobless claims, lower level of employment gains, weaker manufacturing sector, ongoing weakness in the housing sector, and ultimately a consumer that bears the brunt of the bulk of those effects as you get further into next year. I would be careful not to say ugly, because ugly implies to some people like a 2008 style recession, and it doesn't necessarily have to be that, obviously. It could be something more akin to the early 90s, which was much more manageable.
So you're saying that's not in the earnings expectations or in the markets yet?
Well, the earnings conversation is also a bit nuanced in the sense that on the one hand, I've argued, and I think everybody has, that earnings expectations were too high and needed to come down. That's in the process of happening, no surprise there. But at the same time, at the risk of being a broken record on the channel, nominal earnings or a claim on nominal GDP, and the nominal GDP is doing okay, albeit going to be growing more slowly, and that should perhaps boost nominal earnings growth more than perhaps some of the more bearish forecasts expect. But that said, I think we should, for the next couple of months for sure, expect those earnings expectations to continue to decline.
So how are all these ideas, how are you positioning the portfolio to reflect this?
Without getting too specific about what we're doing, for fear of upsetting regulators and my entire compliance department, I think in a sectoral sense,
they're out shopping.
They are definitely out shopping. That I can confirm. Listen, we've long liked energy, not as a trade, but more of a secular tailwind for reasons that have been articulated numerous times before. I think we stay there. I think some on the consumer side of things, the movie theaters and the movie-going space, if you will, is an area that we continue to focus on. That's been something that Solus has been long been involved in. So I think there are sectors and there are themes that you can still find attractive if you have that early 90s style slowdown, so to speak, or recession. I think the fear everybody has, obviously, is something more dramatic. And in people's defense, if you're our age, and I'm considerably older than you.
Oh, no. How much older?
No, but by many decades.
I think that's true.
If you're my age and Josh Brown's age, let's say, you're accustomed to 50% drops in the stock market being the, quote, norm. That's obviously being 2000 and 2008. That's obviously not the case. Recessions can be associated with stock market declines on the order of 25 or 30%. And I would remind viewers that at one point not that long ago, the S&P was down 25%. So if you have a normal recession, you could argue, I'm not sure I'm making that argument, but you could argue we already had the downturn that would be associated with it.
Yeah, now only down 16.5%
That's right.
off the highs for the S&P. NASDAQ still down about 30.